Clinic. Tonight, we're going to be answering all the burning questions, the financial burning questions that are concerning you at the moment. But before I start that, let me first tell you, or let us first tell you a little bit about Moneyfarm, our products, our services, and how we will go about helping you achieve your financial goals. So today's discussion will focus on how our platform works and how we will be able to help you with your financial goals. On our panel tonight, we have Richard Flax, who is Moneyfarm's Chief Investment Officer, and we also have Chris Rudden, Head of Investment Consultancy at Moneyfarm. So we are going to also, before I hand over to Chris, we're also going to be answering your questions. So please look into the Q&A section and please do ask any questions you want to while we are talking. We can always interrupt the session to just address those questions and answer them. Or at the end, we do have a slot for that too. So without any further ado, I'd like to hand you over to Chris.
Thank you, Angelique. Good evening. So before going into the deep dive and discussing specifically the points around what to think about when investing, answering the questions that you guys have, as Angelique says, please send them in as they come. I just wanted to go into a little bit about who Moneyfarm are, just for those of you who don't know, just to give a bit of background. So Moneyfarm is a digital wealth manager. So what does that mean? So the wealth management industry has historically always been incredibly opaque, quite inaccessible, and generally quite expensive. And what we're looking to do through the use of generative technology and obviously new ideas is really break down those barriers and make sure that, well, wealth management is accessible to all, everybody who needs it, which many people do. And it's not so expensive. Generally speaking, we can bring the fees right down and incredibly transparent in what we're doing, because obviously there's a lot of, let's say, news over the last 10, 20 years of, let's say, people not doing the right things. I think generally transparency is incredibly key in this day and age in the financial sector. So as you can see on the screen, this is our kind of view, and we like to bring, very human touch along with technological sides of things, just to help us to get through. Just a few numbers about who we are. We have about 85,000 clients in 2 countries, which is Italy and the UK. £2.5 billion of assets under management, which we are looking after on behalf of our clients. And we kind of have 5 different partners, which we kind of help to distribute the product through some business-to-business activities as well. On the right-hand side, you can see a variety of our investors, people who have a stake in Moneyfarm and are helping to drive us forward, not obviously with capital, but also with their experience and huge knowledge that they bring to the table as well. Speaking of huge knowledge, so I always find that it's incredibly important that, whilst obviously everything we're doing is new and innovative, we are led and driven by people who have huge amounts of experience at the top of the field. So obviously, as you can see from the slide in front of me, or in front of you, we have, obviously at the top, we have Giovanni Dapra, who is our CEO, who learned his trade at Deutsche Bank. The gentleman to my right, who will be addressing you guys shortly, obviously has great experience at some of the top places in the city, which is Morgan Stanley, Goldman Sachs, PIMCO. And then I've picked out Isabel as another one of our ExCo members, again, applying her trade at companies such as BCG, Capital One, and learning a lot of retail experience from Expedia. Again, having people at the forefront of each industry to really bring that expertise to the table. So enough specifically about us. Going on to, let's say, what to think about when investing. So I've taken one of probably, for me, the most important parts of our service, which is the investment suitability. For me, suitability is one of the most important yet underrated parts of the investment process. And what we always find is that for investors, their biggest obstacle, their biggest enemy can often be themselves. And what I mean by that is people don't truly understand their risk appetites. And what you tend to find is that, particularly, for example, when markets are going up, they will look to buy investments which probably are too risky for them because they change the returns. They see that over the last 6 months they've done really well. I want a piece of that action. My friend's been telling me about this. It's really great. And on the way up through markets, because we know markets go through cycles, you have the ups and downs. we always find that on the way up, people will take on investments that are too risky, and then buying in higher and higher into risky investments. And then when markets turn, which they inevitably do, because that's how they work, suddenly on the way down, they suddenly realize they can't stomach this level of volatility, and they start to sell and they start to de-risk, and possibly de-risk too far, at the bottom of the market or near the bottom of the market into things such as cash or very low risk bonds, premium bonds, etc. And history always shows, and there's a lot of studies that you can find out there, that, let's say, the average investor in terms of their decision making tends to underperform a broader market. And the reason for that is because they've never gone through a proper suitability process. They've never really taken the time to understand, what is my level of risk? What can I truly stomach? And I think it's quite interesting that, to be honest, the best investments you can make are probably boring, because they don't worry you, they don't excite you, they are truly within the range of what you're expecting and what you're hoping for. So that's why, for me, suitability is incredibly important. And because it helps you just to sit through, ride out the markets, take the ups and the downs, and not make the decisions which generally are the typical pitfalls for real investors.
Yeah, and if you make the wrong decisions, you have that double whammy effect, don't you? Because the markets are going down and you've made the wrong choices in terms of what you've invested in. So you'll be hit twice, really. Exactly.
So it's the case of, there's the old adage, and it's obviously very cliche, of buy low, sell high. But essentially what people tend to do is buy high and sell low, because, as we know, market cycles are driven by, you kind of start coming out the bottom of a cycle and you're still like, everybody's cautious, people are not, don't buy into whatever. And by the time you've reached a point of confidence and, excitement in the market, you're generally near the top of the cycle. And this is where tradition, it happens at every level, but this is traditionally what people have to do. And then, like you say, the double whammy is that when they're in the peak part of the, let's say, the real point of negativity is generally near the turn, near the bottom, and that's when they will de-risk. So it's that double whammy of getting it wrong twice, basically. Exactly. And that's why. So I've got it on the screen. Part of our process is essentially that. So the first part of the process, which is what any wealth manager will take you through, is that the first thing that we ask you to do from a digital standpoint is to run through a suitability questionnaire. We will take your attitude to risk. We will take your attitude to various market situations, your knowledge, etc. And then we'll ask you also about your time horizon, which is incredibly important as well. So the longer that you can invest for, the more risk you generally can afford to take on, because, as we discussed about market cycles, they will play themselves out through the ups and downs. And generally speaking, some of the longer time horizon can generally afford to ride them out a little bit more, particularly equity time horizon, which is equity risk, which is obviously has more volatility, but historically has performed better. Then the longer that you can have, then the more risk you can afford to take on. But again, it's a very important question to ask and to understand, and very important to get you into the right portfolio as a result. So that is in terms of getting to the right risk level, getting the right investments, getting to the right risk level. And then obviously the man to my right will talk you more about the investments themselves with much more aplomb. But I think,
Chris,
yeah, of course.
With regards to the investment horizon, you were picking the number 10. I mean, is it only for people that have got a 10-year investment horizon, or is it, what Moneyfarm offers for anybody?
Yeah, it's a good question. Obviously, as you go down the risk spectrum, I generally find that people should be taking less and less risk. So generally speaking, if you have kind of up to 1 year or so, you have to be very, 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 let's say, have a high risk appetite to do anything more than cash, for example. Then as you slowly build up from there, you can afford to take more and more risk on. And generally speaking, we would look, if we had somebody who tried to invest for less than 2 years, I think we would ask them some serious questions and say, look, do you really understand the pitfalls that you're coming into? We actually have a slide later on, which talks about if the effective time horizon and your probability of coming out with a loss, as time goes on. And what you find is with 1 year, I'm spoiling it slightly already, but with 1 year you kind of have it, it's around kind of 40 to 50% that you come out with a loss, and this falls pretty rapidly as you go through time. And then suddenly, the probability of coming out the end with a loss is much lower. So generally speaking, for us, we would say that kind of 2 to 4 years for us, we'd consider short term. But like I said, we have the suitability engine to accommodate that. and we have, we will put that into the thought process, and we'll put that into the mechanism. Then kind of 4 to 6, 7-ish is probably around midterm. And I think that's, it's a very relevant time period, because a lot of people will have that time period, whether it's, I'm looking to save for a house. Not every goal is retirement, I think. So obviously you have to factor in those midterm ones like house or whatever. And that, as a result, we can cater for that, and we'll make the portfolio suitable for that particular environment. And then obviously, as you say, longer term is obviously helpful to be, a chance of better returns, but obviously, is probably just one of your goals.
Speaking of returns, we've got a question here from Jay Budham. Excuse the mispronunciation if I have mispronounced it. But Jay asks, if I invest £10,000, what is my return on investment on a low risk investment? Do you have any views on that, Chris? Or
I mean, unfortunately, predicting the future is incredibly tough to do. Yes. I mean, we have a section later on about expected returns. Again, it's a science, but it's not necessarily a complete answer. Generally speaking, again, I would encourage that person to probably get in touch with us. It's quite a tough one to answer in terms of being specifically in a low risk portfolio. We will touch on expected returns later on, but say, for example, if they're looking over a 3-month time periods, that's a good, as good a guess as anybody's. If we're looking over a 5-year time, 10-year time period, then we actually have the numbers for this later on. And so keep an eye out for that. But again, it all depends on the time period. It depends on the types, specifically the time period, to be honest. And giving a specific answer about, okay, in 3 months you'll have this, in 6 months you'll have that. It's not impossible to do, I would say. Right. Apologies if that wasn't the answer you were looking for, but hopefully we can address it later on. So just moving on to the next slide in terms of this point, it's once you've got your portfolio and once you've got your suitability, the key point really is to think about what is the best vehicle for you to invest in. And we've got a selection here that we have, and generally that covers the broader sphere, but obviously there are other vehicles out there. But the key point generally, which differentiates these, is usually tax treatment. The UK government actually gives quite a lot of, let's say, quite generous tax wrappers. So we actually have products in Italy, none of which, with nothing like the ISA, for example. And so something like a stocks and shares ISA, where you can put money into an ISA, you can put money into investments up to £20,000 a year, and all of it is completely tax-free. Is generally, for most people, the starting point, because there are very few, let's say, restrictions. You can take the money out generally whenever you want. And obviously the restrictions in terms of amounts, but after that, generally speaking, there are not that many strings attached, and you have the tax-free allowances that you get. And we were actually discussing this beforehand, but this year is actually more important than any to actually get money into tax wrappers, because actually in the next couple of years, after the budget was announced, after the last budget, actually the quite generous capital gains tax allowances that people used to get in terms of money outside of tax wrappers, they could still get capital gains and not be charged. These are coming down pretty rapidly over the next couple of years. So at the moment, it's about 12,300. This comes down, I forget the exact figures, but it's roughly 6,000 next year and roughly 3,000 a year after that. Yeah,
so your ISA allowance isn't even guaranteed either necessarily if they are changing thresholds elsewhere.
Absolutely, they will have the power potentially in a couple of years to say, oh, instead of 20,000, you can only put 15,000 in. I think it's highly unlikely they'll affect, obviously. So that's why it's important to get it in now while you have that allowance. Because maybe in the future, they might get rid of the ability to put money into the ISA entirely. Obviously, the stuff that will be in there will be protected.
I've got a question here from somebody called Mihai. He or she is asking, can you give an example of how the tax-free allowance actually works? So maybe you can just...
Absolutely, very good question. So generally speaking, actually, it is an amount that you can put into a wrapper each tax year. So with the ISA, for example, you can put up to £20,000 each year into an ISA, and next year you get another 20,000. The year after, you get another 20,000. Whatever growth you get in there, say for example you bought, I'm making a very extreme example, but a fledgling junior, very young tech stock that doubles, so it goes from 20,000 to 40,000 in a year. Or it doesn't matter how much is in there; it's the contribution that matters. So once it's 40,000, it's still protected. You could go up to 100,000, it's still protected. It's the money that goes in that's relevant, basically. And so that will be covered from capital gains tax, crucially, and then also tax on dividends and tax on interest as well, particularly if you have cash or bond related products. So generally, most of the taxes that you, well, all the taxes you associate with at least a UK resident investing are covered within the ISA. Similarly with the junior ISA, before we get onto that, but that's the same sort of thing in there. You'll get up to £9,000 that you can put away for a child in that one. But yeah, moving on from that, I mean, obviously again, key to use the tax wrappers, as I say, another one is obviously the pension. There's a lot more complexity around a pension, but it's still a very, very key product for saving for your retirement, crucially, because the key point is that you can't touch the money that goes into a pension until you're 55. Which probably will soon be, well, will be 57 for a lot of people by the time they retire, and possibly even more. However, the key point being is that for a pension, money that comes out, so everything that's in the pension is covered for capital gains tax, dividend tax, and interest, as we've discussed, the same as with the ISA. However, the big difference is when you take the money out of a pension, it is considered income, and it will be charged at income tax. Apart from 25%, which you get tax-free, which is, again, a big bonus, which can be managed as part of a plan. But crucially, money that comes out will be taxed at income tax. However, the key point is the money goes into a pension before income tax comes off. And that's the whole point of why it gets taxed on the way out. Money that goes into an ISA, you've already paid income tax on generally. You kind of pay your income tax, then you put it into an ISA, and then it comes out free of charge on the other side as well. However, for a pension, generally speaking, your traditional pensions are with your workplace, they'll get paid in before you pay your income tax. And as a result, they get taxed on the way out. So that's a key difference. Money's already been taxed in ISA, money hasn't been taxed in a pension, gets taxed on the way out. Any contributions into a personal pension from your, let's say, your bank account, they will generally get tax relief as a result. So basically, because it's meant to have been before income tax was taken, essentially the process is you get that money back onto the contribution. So most providers, including ourselves, will give the basic rate as default. So if you sent £10,000 into a personal pension, £12,500 would appear, which is the kind of the gross, let's say if that was your gross income and your net income number. And then if you have more, you can claim the rest from through a tax return. Then, as I say, we've got the junior ISA, which is then kind of halfway between the two, because it has the ISA protections of an ISA, but it also has a little bit of a, the child can't touch it until they're 18. So it's a kind of a fund, a trust style product where you can put up to £9,000 a year away for your child. You can't touch it once it goes in. The child can't touch it once it goes in. So that's very important. And then when the child turns 18, that will turn into an ISA for the child or adults at that point. And you can go from there. Now, the crucial thing is you can only have one junior ISA per child. However, anyone can pay into it. So grandparents, uncles, aunts, friends, godparents, whatever, can pay into a junior ISA. And it's a good way of getting a child that kind of, or an adult at the point at which they get the money, that kind of starting boost in adult life, which is a great way to go. And then what we find is the general investment account traditionally is for those people who either aren't eligible for the ISAs, or they have used their allowances already, and this is kind of overflow cash. And then this is just investments, which if you reach the kind of the thresholds, will be charged to capital gains tax, dividends tax, etc., etc. So these are kind of your traditional products. These are traditional products that we have, but it's the same elsewhere. So the key point, once you've picked your suitability, once you know your risk level, is to know what the right product is for you. And it might sound complex. I know I've talked for a little bit about them, but generally speaking, the process is simple. It's if you're eligible for those allowances, use them first, basically. And at the bottom you see there transfers. Transfers are possible if you have them somewhere that you're not happy. So, for example, you've got a cash account that actually it's meant to be for the longer term, and you think, oh, maybe that's not the right product where right place it should be, or conversely, you're with a provider you don't enjoy. You can always move money around as well, and it doesn't leave the wrapper, crucially. So that's the key point of those things. So always available from that side.
Is it quite easy to transfer your pension?
Yes, in principle, yes. Now, what we find is obviously it's a relatively archaic industry. However, there is a lot of change that's happened over the last, let's say, 10 years or so. So many places now subscribe to this electronic transfer system. which we were obviously part of as well. And so actually, for the most part, for example, if you were to do it for ourselves, it's completely paperless. You do it on the platform, you fill in a few details, it goes off to our transfers team, and then they reach out to the existing provider, and then a couple of weeks later, the money arrives in your Moneyfarm pension, for example. However, there are instances where it can take slightly longer. If the other provider is slightly more old-fashioned, demands everything by paper, then it can take longer. But we find that about 80% of transfers are through Origo nowadays, so it's getting much, much better for sure.
Right. I have a question from Philip Bettinson, and he says, I am due to retire in 30 months with a pot of £20,000. However, I will be taking a lump sum, possibly quite soon, and go into drawdown to fund my income, as I will be working part-time, drawing £2,000 a month from the next tax year. I expect to add to savings by ISA due to £4,000 contribution limit in terms of my time horizon, and I'm thinking it is at least 10 years, and I hope that will grow, but of course it may not. So he just wanted to get some general thoughts around that.
Oh, Philip, thank you for sharing such a large amount of information. So I think the key really is to understand, okay, with £200,000, 30 months. Yeah, I think the key in retirement is always to understand where your income is going to come from. That's all, because obviously the whole point is you're no longer working, you need the income. And I think it sounds like you have, obviously drawing down, you have a plan. And then because you have the income coming from the pension, essentially it means that it will allow you to take a longer time horizon, if I understand correctly, in the ISA, which you're looking to do. So that makes sense. So one of the key facets about time horizon is obviously when you need the money and liquidity requirements that come through that. And so if you have something that you think, particularly with the part-time work and the drawdown from the pension, which comfortably covers your lifestyle, I think then having a longer time horizon with your ISA does make sense, because essentially it allows you to, because you feel relatively confident that you're not going to need that money and not going to touch that money, you can just let it go with the general flows of the market, particularly slightly more equity exposure probably over a longer time horizon, and that will allow you to reap the benefits of having that higher risk over the longer time frame, generally speaking, because as we'll see later on, obviously we can't make guarantees of any returns in the future for sure, but having a longer time horizon does give you a better probability of success in higher risk portfolios. So on the surface, without going much deeper, and let's be clear, I haven't got the full picture here, so please don't take this as complete holistic advice, but on the surface, what you're doing, it does seem to make sense.
A much more simpler question. So again, from Mihai, and he or she says, is the tax-free allowance for the junior ISA separate from the stocks and shares ISA if I open both?
Fantastic question. Yes, it is. So what it does mean is that for, let's say, a very well-earning family, and if you're in that luxury position, well, congratulations, you have a £20,000 allowance for both parents, and then you have £9,000 allowance for each child, which you can put away tax-free. Obviously, not everybody's in that luxurious position, but if you are, it's a great extra way of putting away money tax-free, but you can also allow to put away for your child's future as well. So it's a bit of a kind of a win-win in that situation. So yes, absolutely, it is separate. Fantastic. I'm just going to touch on a couple more points, and then I'll hand it back to Angelique and Richard. But one thing that we've launched recently is essentially as part of the portfolio. So obviously, we talk about the right wrapper, we talk about the right investment strategy for your goals and for your time frame. One thing we've actually introduced is an element of customization, actually, which people can actually add into their portfolios. So the key point really here is we're doing it in a way which we call here call satellite, which obviously might not mean much to a lot of people, but essentially it means it's a way of doing it relatively responsibly. So rather than going, as I mentioned before, completely gung-ho into, let's say, some new themes, some new kind of trends, which perhaps might not be suited to your risk level, we take it as part of your suitability. So say, for example, you're a medium risk portfolio, we'll build you a portfolio which is very much medium risk, kind of core, as we call it. And then we'll allow you to add some customization that goes around the outside into certain themes which you might be interested in, various technology and innovation projects, demographic and social shifts, sustainability. And those are the key kind of trends that we're going to have within those. Things will change throughout. But what it means is that we will limit the amount of theme that you can add based on risk level. So that's the core thing, and say, for example, it can go from kind of 0% up to 20% in the highest risk. If you're medium risk, I'm making the numbers up a bit here, but it will be around 5% that you can add in. And then that way it's done responsibly, it's done suitably. But obviously you get that element of customization. You can get that kind of, okay, I want to be part of those new trends that are coming through that I see on the news, or I'm really interested in this. It will allow you to add that little bit in. So I think it's just quite an exciting thing for us. Again, it will be managed. So that's another factor, which is really good. Obviously, the gentleman to my right and his team will manage those. And that way you don't have to go through the stresses and strains of finding a suitable allocation and obviously then managing it yourself.
Chris, if I can just interject, the thematics, like you were saying earlier, is you have your core, which I presume you were referring to the boring
yes, exactly.
parts, right? And then thematics is our little sexy versions, right? The thing that I wanted to ask, and this is from our one of our audience members, Al, and he was saying, do you only offer managed SIPs, or do customers have the option to manage their own portfolios? And then he says here, which is again something I could link into our thematics here, he goes, or she goes, can all the products be tailored to ESG principles? And I know that that's something that we do with thematics, don't we?
Yeah, absolutely. So actually we do it with thematics and we do it with the core. So I'm very grateful that you asked that. Thank you, Al. When a client is choosing their allocation, so they're going through the process, sorry, not choosing the allocation because the gentleman to my right will choose the allocation, but they can choose choice of two options. They can choose a classic, which is essentially everything's done through just financial models and we look only at financial factors, but actually we also have an ESG range of exactly the same portfolios, and the ESG range will then screen out predominantly. We focus more on environmental factors, although we have please correct me if I'm wrong, Richard, but we have a lot of other, but there are other factors in there, a lot of social equality and good governance factors as well, but majoritively we focus on environmental factors. So particularly looking at, say, for example, we find that we want to invest into a certain area, then we look at that area, we'll screen out the biggest carbon emissions members of that area, specifically commodities as well, all of this sort of stuff, and we'll screen out people who don't conform to the Paris Agreement, all of this sort of stuff. And then, so we have a range of essentially 7 portfolios, of the core, and then 7 classic, and then 7 ESG of, matching the risk levels, but with the ESG screening on them. On top of that, we have one of the mega trends that we have is sustainability, which we focus more, let's say that the ESG core side of things will screen out bad companies, let's call, for the sake of this, whereas megatrends actually allows you to then invest directly in let's say things such as clean water and wind energy and all of these sort of things, whereas obviously the core will be screening out high carbon emitters. So it kind of comes from both sides, and it allows you to then do slightly more closer to what you call kind of impact investing, if that makes sense. Right. So yes is the answer to that question. It allows you to customize. Oh, in the SIP, yes. I mean, obviously in the SIP, it is the same with all products. Sorry, please excuse that for me for missing that. It will be across all products that we have, basically. So the portfolios will be the same. It is simply the wrapper that is different, basically. And that's the key point, is how, because once a portfolio is suitable for a certain time horizon or certain risk appetites, then there's no need to change it. It's simply the tax treatment that goes into it. So, for example, if you had exactly the same, let's say, attitude to risk, yourself obviously, and you had the same goals for the ISA and the pension, you would have the same portfolio, just inside a different tax wrapper, basically. Yeah. So and so everything that we say on the portfolio side of it is relevant for all products.
Right. And I mean, the other major megatrends that we've got in thematics is the technology and innovation, and we've also got demographic and social shifts. Do you want to maybe just expand a little bit about what those are about? I think with technology, we may be able to invest in things like space or some other sort of sexy thing like that, right?
Richard, would you like to take this one? You might be better suited than myself.
Yeah. So look at, I mean, there are a couple of points to make. I guess our goal obviously is to think about broad themes, but within those broad megatrends, there are a range of kind of sub themes, and those are the ones that we're looking at, and we can, there's enough product around on the market to be able to take different opinions depending on the themes that we think are most interesting. And so, you know, when you look at what we're doing today, if you think about clean energy, or if you think about robotics, or you think about things like this, where you can be a little bit more targeted in those sort of exposures. The baskets today are still quite growth focused. They're obviously looking out into the future and thinking about how the world is going to look in the next 10, 20, 30 years. So they have a bit of a growth bias to them, rather than perhaps some of the more value oriented companies that you might think about. But within that, it's a way of really taking advantage of some of the broad shifts in the global environment that we expect to see over the coming decades. Think about ways of adding that to the portfolio in a risk controlled manner, right? So when you think about those baskets, they could be a little bit more targeted. They might be a little bit more volatile. Obviously, we think that they have a lot of potential, but we're trying to put them in the broader context of the client's overall risk appetite and risk tolerance, and make sure that it's continues to be properly managed.
And it's all equities, right?
At the moment, it's all equities, yes, in those baskets. But that potentially can change. It's not a requirement that it will always be all equity.
Right. Okay.
But as of the baskets we have today are.
And Chris, just to go back to you, the minimum investment that you would need for Thematics?
Yes, is £10,000 to have for the portfolio. That way, it allows us to build a strong core, and then obviously have a satellite which is again sufficiently diversified, because actually the satellite itself is not going to be one ETF or something like that. But you know, and the portfolios themselves, the core generally has around 14. I mean, it can vary. Excuse me, it's no strict rule, but generally speaking, the reason for that amount of money is obviously it allows us to build a strong enough core to support a big enough relevant satellites, basically.
Perfect.
Fantastic. So last couple of points from me, and then I'll hand over, is just on fees. And again, going back to, let's say, from a clinic standpoint, one of the most important things that you can do once you've kind of picked your suitability, once you've got your wrapper, is generally, how do you keep your fees down as much as possible? Now, obviously, it's relevant to kind of consider what you're paying for, because obviously, you know, you have a lot of other, let's say, kind of free trading apps and all this sort of stuff, which exist. However, obviously, then you have to pick your own investments, you have to pick your own suitability, you have to go through all of that and make sure that everything everything you have to do yourself. Whereas obviously what you're paying for here is everything done for you, essentially. And that's where obviously we talked about at the start of the events, was talking about kind of the digital innovation, digital side of wealth management. Traditionally, wealth management will cost you somewhere between kind of 1% and up to 5% per year is what we hear. So
that's quite high.
It's very high, and it's sometimes incredibly surprising when we speak to someone and they are paying, you know, up to kind of 5% a year, and that's, for a lot of people, that's a huge chunk of the potential returns. And we'll get onto that in a second. But so the key really is to manage that, because obviously and again, I'll show you in a second, but where obviously returns can compound through time. So you kind of see the compounding charts, so do fees, and so does the effect of fees. So something that can always seem small at the start can really build up through time, particularly on a longer time horizon. And obviously big things can compound a lot. So this is the fees that we have for our actively managed range, managed again by the gentleman to the right and his team. We also actually have more recently a set of products called fixed allocation. So again, you get everything that you get with the actively managed range, but you still get the suitability, access to the consultants. So the team, my team, and you know, a couple of whom are kindly on the chat function helping away. You might have had some questions answered from them, but access to all that, the suitability of the platform, everything trading, simply, you know, it cuts out the management from the portfolios. The portfolios are still built by Richard and his team, but they're not. They're generally for longer term investors, and they would say, look, we think this allocation is good. We're not going to trade it throughout the year. Whereas obviously what Richard will do, and he'll get onto that in a minute, him and his team will make changes to the portfolio throughout the year based on certain events, whether it be wars, whether it be budgets, whether it be whatever. And so as a result, we have a set of portfolios, and they cost much less, which is great if that's what you're really focused on. But obviously it doesn't have as much of the management side of things as well. But we offer them because we still think they are suitable product to offer. And I get the last point is really on that fees point I was talking about. So just to explain this chart here, we have the returns of the MSCI world, which is one of the most kind of broadly accepted global indexes of stocks. So it's basically, if I was to put it into a really kind of simplify, I would say this is global stocks, weighted by the size of the market, etc. Here we have essentially, if you'd invested into the same products with two different funds. So here is an ETF investment. So ETF is an exchange traded fund. It's a type of fund, and mutual fund is a slightly more well, it's just a different type of fund, generally more actively managed. For the purpose of this exercise, they invest in the same things, just with different fees. So ultimately, the returns are exactly the same because it's the same underlying investments. The ETF charges 0.2% a year. The mutual fund charges 1.7% a year. Again, both seem very reasonable within the scope of kind of mutual funds and ETFs. And actually, we use ETFs in our portfolios for this exact reason. But what you see is over a 20-year period of the MSCI World, looking at the performance through time, simply having the same performance but different fees cost you somewhere just shy of about £80,000 on a £100,000 investment. So 80%. Over 20 years will cost you 80% in terms of returns. Just a simple difference of 1.5%. So that's the effect of the compounding through fees through time. And that is why keeping fees to a minimum is keeping fees as low as possible, because again, you have to think about the value that you're getting for the fees you're paying. But keeping fees as low as possible while still maintaining good value is an incredibly important part of the investment cycle. And yeah, almost one of the most crucial ones, along with, let's say, the right products and the suitability. So that's it from me. So again, the key points of starting the investment cycle and obviously getting up to the point of actually making the investments is suitability and make sure you're in the right investments, because actually if you're in the wrong investments, you start making knee-jerk reactions. That's when you actually make bigger losses than some of the investments themselves over a longer period of time. Choosing the right products, because these are a key part of the arsenal that you have available to you, and obviously managing your fees.
With regards to the fees, we have another question, and this one's from Rod, and he's saying, since when have mutual funds charged 1.7%? Maybe if you can expand a little bit on that, where those figures come from.
Yeah, of course. I mean, we do a lot, and again, this is something that people can get access to. We do a lot of activities called portfolio reviews, basically. So we assess people's investments with third party providers. We build them a report to see how good those investments are, from fees, from performance versus their benchmark perspective, etc. as well. And what we tend to see is that's where we get most of our market information about mutual funds. Now, obviously, mutual funds can be much less. This was a figure used specifically just for the purpose of this exercise, but it's definitely not outside the realms of possibility. I haven't got a specific figure to hand. I would imagine, off the top of my head, the average mutual fund would probably be around 1.5%, I would say, on average, because you can get a lot of complexity out there. You get a lot of, let's say, market neutral funds or something like that will charge you well more than that. So this one, in answer to the question, is obviously just chosen for the purpose of this exercise, but there are definitely a lot of mutual funds which charge around this sort of area. Thank you. So I've spoken a lot about kind of what decisions to make before the investment process. Now our expert investment manager, chief investment officer, Richard will talk you through our investment process internally.
Very good. Thank you very much. Thank you for joining, everyone. Next slide, I think. So look, I'm going to talk a little bit about our investment process. There are a lot of different ways to invest. And so I'm going to try and put what we do in a broader context, at least as we see it. And I guess the first question to ask is, well, how do we spend our time? And broadly speaking, we spend our time thinking about macroeconomic variables, policy, and their impact and their interaction with financial markets. There are other people who do things very differently. They, for instance, may spend their time thinking about analyzing individual companies and picking the best stocks. Whereas we spend our time thinking more about aggregates, about geographies, about sectors, about countries. We think that picking the right stocks is very hard to do that consistently over time, and we think that picking the manager who is going to pick those stocks well over time is also very difficult. And really, you need to get both of those things right. And it can be done, but it's pretty challenging. The second thing to make, I guess, is about managing risk. We want to make sure that the portfolios that we have are well diversified, that they have a lot of different exposures in terms of asset classes, in terms of geographies, in terms of timeframes. And hopefully that comes with a certain level of humility about our ability to forecast, or anyone's ability to forecast the future. Again, if you had absolute certainty about the future, you wouldn't need to diversify. You would simply know what the answer was going to be. So diversification, which is often referred to as the only free lunch in finance, is really a reflection of the fact that none of us can know the future, and so we need to build portfolios that perform well when things go the way that you expect, but also hold up okay as best they can when things don't go the way that you expect. And that's part of the risk management process. The other thing, and Chris has mentioned this, but let me just reiterate, is really about time horizon. You know, people talk about edge, about, well, what's your edge in finance? Why are you going to do better than anybody else? And we continue to think that the time horizon the longer time horizon you have there's the best edge you can have in terms of ensuring that you achieve your goals. Having that long time horizon, being able to save consistently, being able to keep costs low, as Chris mentioned, these are the things that really are the best way to try and ensure that you achieve the goals that you have. So with that, let me I won't go over the point about cost. Chris has covered that in some detail, but I will just reiterate and say it is critical, thinking not just about the instrument costs, the mutual fund costs, the ETF costs, but also the platform costs that you might achieve. You know, sometimes you may buy a relatively cheap fund, but you will be charged a platform fee for it, and so you need to think about that cost as well. With that, let me turn on to the next slide. I want to take a second just to talk about the integrated proposition. Chris has obviously talked about the left-hand side of this chart, which is around suitability and risk tolerance a lot. And I wanted to relate that back to the right-hand side of the chart, which is really the investment committee and the investment process. And for us, it's about defining portfolios. It's about thinking about the long-term expected returns for different asset classes. And I'll come back to the question that was posed earlier about that. But also thinking about what we call the tactical asset allocation, which is the adjustments that we make over the course of a year or 18 months to either manage for risks that we perceive or try and take advantage of opportunities that we see. The other part is then about instrument selection. It's one thing to develop a view about what you think about the world and about how you want to be positioned, but then you need to think about the instrument that you're going to use to implement that. And we look across the market at different exchange traded funds, and we focus on things like the total cost of ownership, how well these funds replicate the indices that they're built on, how effectively do they give the exposure that we want to have. You know, how are they constructed? Are they built? We have a bias towards replicating the underlying index, buying a little piece of each of the individual stocks. These are the things that we focus on. The ETF landscape is a very dynamic one. There's a lot of new instruments that come out, and we try our best to stay on top of that to make sure that the instruments in the portfolio are still best in class. So let me go on to the next slide. So what does it mean? You will see if you're for instance invested in our classic or our ESG portfolios, these portfolios being managed over time by us making adjustments in fixed allocation, as Chris mentioned. Usually we make an adjustment only once a year, but again, we're still constructing those portfolios and selecting those exchange traded funds. But beneath the surface there, obviously there's as you may imagine, an awful lot of work that goes into that, thinking about long-term perspectives, analyzing on a daily basis financial markets, building models to try and assess the relative value of different asset classes. These are all of the things that we spend our time doing to try and make the best decisions that we can over time. If you want to read more about it, if you go to the next slide, there is an investment strategy document that we're very happy to send out, and that will give you a more in-depth sense of the stuff that we think about and the way that we approach the world. So now on to the question that was posed at the start: is now a good time to invest?
Yeah, that's always a concern, isn't it? I mean, particularly now, if someone's got in a year or two ago, they were really worried about their investment, right? So what is your kind of advice to those jitters that they have at the moment?
Yeah, so I guess we go back to the starting point around time horizon and about making sure that the portfolio and the exposures that you have are consistent with your, not just your risk appetite, but also your time horizon. And when we think about that, again, the inevitable caveat that we don't make guarantees, we can't, know the future perfectly, but let me relate it back to our process. If you go to the next slide. So every year we do what we call a strategic asset allocation process. Lots of other firms do something similar, but what we're doing here is really taking a step back and thinking about the long-term expected returns for different asset classes. And the real drivers there are first and foremost about what the global economy will do, right? So we have a view that says that the global economy will be a crucial part of the expected returns that financial assets will generate, either in terms of growth or inflation, in terms of what sort of profitability companies can achieve. And the second part is really about starting valuation. And starting valuation in the short term, over a 6 or 12-month horizon, may not matter that much, but over a longer term generally is a key driver. And so what you see here are the expected returns that we've generated over a 10-year annualized time period, a 10-year period, for the different asset classes. You see that on the lower risk spectrum, government bonds in nominal terms, our expected returns are sort of 2.5. Going up as you go towards developed market equities, US, Europe, etc., somewhere 7.5 to 8% returns. And again, emerging markets, an improved position there. But the second chart, the next chart, is probably the more interesting one, because that puts these returns in some sort of context. Again, the process that we follow is quite mechanical, so there's relatively little scope for our, inherent biases or judgments to come into play here. And what you see here is the same basic process being run over the last 5 or 6 years, and those expected returns again being shown. And so what we see is that after a period of relatively low long-term expected returns, you now actually begin to see a bit of an improvement. You see it it's more pronounced in government bonds, given the increase in bond yields that we've seen over the last 12 months, but also in terms of equities as well, that equity returns look a bit better than they have done over the last couple of years. And so what does that tell us? With the important caveat about having a long enough time horizon, it suggests to us that the current environment is a decent one in which to start to invest. Again, that's not to say that the next 12 months won't be challenging. They might very well be challenging. It's a whole separate debate around what's priced in and what will happen to growth and inflation and so on, corporate profitability. But leaving all of that to one side, when we think about the long-term expected returns, the starting valuation, and the potential for returns that come from that, our modeling and our work suggests that the expected returns today are better than they have been over the last couple of years. And then just the last thing that I'll show, which is the slide that Chris has alluded to, is some of our a modeling exercise to look at the probability of loss over different time periods. And so what you see is, and this is for a range of different asset classes or a range of different combinations, so from 100% equity down to 30% equity and 70% bonds. And what you see is that the probability of loss falls relatively quickly in the early years. So if you're as Chris mentioned before, if you're looking out only a 1-year time horizon, your probability of loss is relatively high, although still below 50%, right? But relatively high. But it falls relatively quickly if you're able to extend that investment time period to 4, 5 years and beyond. And that's an important implication in terms of the type of portfolio that you can have, the type of portfolio that might be suitable for you, all other considerations being equal, but also a reminder that compounding those returns over a long period of time is the best way to achieve your long-term goals. And And it feeds back into all of the stuff that we've talked about already about keeping costs low, keeping your portfolios relatively well diversified, and all of these things that we think of as good housekeeping from a long-term investment perspective. So those are the things that I wanted to touch on. Let me turn it back to Chris and Angelique.
Yeah, I think I'll just say one more point on these points that Richard mentioned. I think they're very, very, very interesting. It's a question we get all the time from our clients. You know, is this now a good time to invest? Obviously, for those of you who have been investing in markets in the last couple of years, obviously 2022 was obviously a very difficult year for markets. And as I was talking about at the start about the decision making, people kind of losing confidence when things are near the bottom. And actually, if you look at these expected returns versus kind of history, this is the period in which things are most kind of promising. But I think what it truly shows is the real cyclicality of markets. And what that means is essentially, as I talked about, the ups and downs through time. Markets never always go up. There are always periods that go down. And if you look through a historic kind of, let's say, a traditional 10-year period in history, you'll probably have, again, three years when the markets are negative, a few where they're flat, and a few that are really, really good. And the long-term investor benefits from that. And that's, you know, the long-term investor is the one who just remains patient, takes the rough with the smooth. And when doesn't take too many rash decisions, doesn't make any decisions at the top or at the bottom, because both of which can be detrimental. Just rides it all out. And so after a negative year, generally it looks, at least from the outlook, and at least history shows us that after negative years, generally speaking, you have a better probability of positive years as well. So reiterating a little bit what Richard said, but tying it into what we were talking about before, it's incredibly important for investors. And the key point for investors is just find something where you're so happy with the risk and just take the ups and downs as they come. And history will show you that you will generally come out with a better outcome. And as we show with this one, the longer your time horizon, the better, the better the outcome generally historically has tended to be.
Right, Chris and Richard, thank you very much for your contributions. We'll probably just take 5 minutes to answer any questions that you have. We do have one question that's just popped up, and this is from Tony P. He asks, if you are taking the state pension, and he goes, I'm a few years off that yet, and the state pension has a tax-free allowance, will all your money be taxed bar whatever you have in an ISA? And if so, does it make sense to draw your pension within the tax-free allowance prior to reaching the state pension age, if, like me, you're retired with no other income?
It's a very good question. I think what I would say is there's a lot of factors in there which are probably relevant to your circumstances. So first and foremost, I would encourage you to book a call with us just to go through it properly with one of our investment consultants. Generally speaking, so the same way, the one thing that I think I can say broadly, I hope it addresses the question in some way, shape or form, is that if money taken from the pension is considered income, as a result, you still get the income tax allowances that you do when you're working. So off the top of my head, I think it's £12,300 that you get in income before you start paying income tax. So you will always have that before you start taking income tax. So once you stack a few things up, it gets above that. So some people, for example, will take that from their pension and top it up with an ISA, or top it up from other sources. There's a lot of different factors that you can use, but that's a relevant part of that. In terms of when to take the let's say the 25% lump sum out of your pension, that's a much more complicated question. I think probably one that to address in a one-to-one conversation, because there's a lot of different factors to do with what you then do with the lump sum. Do you kind of find a way to provide yourself with the income? Do you just take the income from something else? Do you put that into an ISA to take the income out? There's a lot of different factors related to your specific situation. So like I said, thanks for the question, Tony. I would actively encourage you to book an appointment with one of our consultants and go through that, and just to really get through the real detail and find out more from there.
Right, well, thanks very much to our panelists, Chris and Richard, for taking all those questions. If you feel that you are still in the dark about your investments, then please do get in touch with us, and we'll do our best to answer your questions. And thank you very much for watching, and good night.
Thank you.
Thank you very much.